Hello and welcome to Virtual Investor Conferences. My name is Phil Carlson, and on behalf of KCSA Strategic Communications, as well as our co-host OTC Markets Group, we're very pleased you have joined us for a fireside chat with NewLake Capital Partners, a leading provider of real estate capital to state-licensed cannabis operators. Their session will be moderated by Pablo Zuanic, Managing Partner at Zuanic & Associates. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view the company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Anthony Coniglio, President, CEO, and Director of NewLake Capital Partners, which trades on the OTCQX under the symbol NLCP. Welcome, Anthony and Pablo.
Thank you, Phil, for that introduction. And Anthony, welcome.
Thank you. Great to see you, Pablo.
Yep, there we go. So let's just start with a lot to cover here. Let's start with a brief overview of your company for those that are not so familiar with NewLake. Thank you.
Sure. Phil, thank you very much for the introduction and welcome everybody. NewLake is an internally managed triple net lease REIT focused exclusively on the cannabis sector. We're the second largest owner of cannabis real estate in the U.S. with 32 properties across 12 states and 13 tenants. Our tenants are some of the leading companies in the industry, public names such as a Cresco or a Trulieve, and we have some of the highest quality private companies such as a C3 Industries or Mint Cannabis. And so some people say, boy, cannabis stocks and cannabis REITs in particular have had a difficult couple of years. But what's really interesting about NewLake is that our original thesis for the company remains intact. And there are, quite frankly, a few situations or only a few situations where the competitive landscape for a company is better 5 years after they started. And so we're excited to have the conversation with you, Pablo, today.
Great, thank you. So let's start first in terms of sale-leaseback and your style of lending here. Benchmark what you offer versus other debt, non-equity capital alternatives for cannabis companies. What are the pros and cons for potential borrowers, tenants? And then also, as you do that, discuss your style or policy in terms of whether you're more or less conservative than others, focus on only some states or companies, any special IP or know-how insights that NewLake has. Let's start with that.
Okay, a lot to unpack. And so again, for NewLake, we are a triple net sale leaseback REIT focused on the cannabis sector. And so what that really means is we acquire properties from and for cannabis operators. We enter into long-term leases with those operators, typically 15 to 20 years. And there's no interruption to their business. They don't have to move out. They don't have to be displaced. Or we provide also expansion capital for existing properties that they may be in. Our terms generally are currently cap rates are running in the low to mid-teens, and our contracts typically have a 2 to 3% annual escalation on the rent. So if you think about that, every year our revenue, if you collect the rent, our revenue is going up 2 to 3%. And we disclose in our investor materials that our average across the portfolio is 2.6%. And so that conversation with operators starts with sale-leaseback is not unique to the cannabis sector. If you were to look at Walgreens, Federal Express, Home Depot, Starbucks, whether it's retail companies that have a large national footprint or organizations like FedEx that need to have large industrial footprint for distribution, they all utilize sale-leaseback as a part of the strategy to fund their commercial real estate needs. And given the dynamics of the cannabis industry, there's a significant need for real estate, both on the cultivation and manufacturing side of the business, as well as on the retail side of the business. And so there lies the opportunity for us to fund into that demand for real estate and the need for capital, non-dilutive capital, to fund growth and expansion for the industry. It differs from debt in a number of ways. And we've had this conversation with CFOs and CEOs over the past few years. With debt, you're looking at a much shorter term of capital. You're looking at the need to repay or refinance that debt, and you're often subject to repricing of that debt on a more frequent basis. So if you were to turn back the clock 2 or 3 years ago when we had many of these conversations, many of the operators chose to use their real estate as collateral and enter into what is ending up being mid to high teen type of yields. And their thinking at the time was, instead of entering into a 12 cap real estate transaction, I'll enter into a mid to high teens borrowing transaction and then I'll be able to refinance out at a much, much lower interest rate in the future, or maybe even execute a cap rate on real estate that is much lower. We advocated for not having to have covenants to worry about, not having to have a refinancing to worry about, not having to have the overhang of significant debt on the operator's balance sheet. And so some people executed sale-leaseback transactions, but others executed debt facilities. And I think what people have learned is that rates don't always go down. And we're obviously living in a world where we are higher for longer. And so when people are coming up, they're saying, I've now paid what could be 15 to 18% yield, and in some cases had to give up equity for extensions or waivers for breach of covenants. They're now facing even higher yields to have to refinance, given the dearth of capital available for the cannabis sector. And so what we like to advocate for is locking away that non-dilutive capital for a prolonged period of time is really valuable for management's time and attention. And so that is really how we differentiate ourselves versus some of the debt alternatives. It's not to say, the last point I'd like to make here, Pablo, it's not to say debt is bad or organizations shouldn't execute. I think debt and sale-leaseback both have places in the cap structure, in a company's cap structure. And we think we'll be executing sale-leasebacks across the industry. It's not a matter of if we will with companies. It's a matter of when does our cost of capital and the cost of that sale-leaseback intersect with the company's desire to execute at that level of cost of capital.
And just staying on that point before we move on to your style and policy, would you say that because of the restrictions around lending and capital for cannabis companies, that to some extent sale-leaseback has an advantage in terms of potential market share compared to your, let's say, more traditional industries?
Yeah, I think a lot of people compare sale-leaseback to taking out a mortgage on the property. And in fact, we have seen operators gain access to mortgage lending, particularly from banks. There have been a few banks that have provided that type of product. But what you typically find is that the advance rate on a loan, whether it be from a bank or a non-bank lender into the sector, the advance rate is typically anywhere from 50 to 70, maybe 75% of the collateral value. And the reason I put it in air quotes is some organizations measure collateral value as non-cannabis value. Some people recognize that as cannabis value. What we look at is typically the capital that's been invested into the property. And so you can think about it as par, or paying 100% for the property and entering into that long-term obligation. And so, yes, I definitely think that there are major advantages to locking in that cost of capital. You know exactly what your rent will be for the next 15 to 20 years for that facility. So there's a lot of financial planning that could go on for the company when it's setting up its permanent capital structure and thinking about its budgeting for the years to come, as opposed to having the need to be considering refinancing, be taking that market risk on pricing. And so you wanted me to talk about style and policy. And so why don't I transition into that? So when you think about our approach, we tend to be more conservative, but it's really an outgrowth of the three pillars of our underwriting approach that we developed 5 years ago. There's three pillars, and you won't be surprised to hear this. Number one is we focus on the company and the quality of their balance sheet and the P&L and their financials, but the quality of the management team. But in particular for this sector, we focus on making sure the management team has the ability to operate a high growth business in a very highly regulated industry. That's a unique set of skills. We also take a look at the management team's ability to raise capital. One thing's for sure about the cannabis industry. This industry has a voracious appetite for capital. And it's one thing to be able to raise that first round of capital from friends or family or close networks, but it's another thing to be able to raise that second or third round of capital when you're typically going to sources that your personal relationships are depleted and you're going to more traditional institutional investors. And our team has raised billions and billions of dollars for our own businesses as well as for clients through the years. And we really have been focusing on that tenant's ability to raise capital. The second pillar is around jurisdiction. This is somewhat unique to the cannabis industry. Your business is run differently from state to state to state, given the very different state regulations. And understanding what those state regulations are and how they impact a business gives us particular insight into a company's ability to be successful in that state or that location, whether it be a cultivation facility or a dispensary. And ultimately, what that's about is, can this tenant generate the significant cash flow that's necessary to win long term, but also importantly to pay rent. And so we do publish on a quarterly basis our EBITDA coverage metrics. That's EBITDA plus rent. And that's a very good measure in real estate of the cash flow that that property provides in order to pay rent. And so we have in what we would consider industry leading EBITDA coverage, and it compares very favorably to non-cannabis real estate industries. And then that third pillar that we focus on is obviously the real estate. We're a real estate investment trust after all. And when you look at the real estate, we're looking not only at the alternative use if this property were to be converted to non-cannabis use, but we're also looking at the importance of that property inside the cannabis ecosystem. Would someone else in the cannabis ecosystem for that state be interested in that property if the current tenant decided that they weren't able to make a go of that particular business? And so I think those three pillars have really served us well over the last couple of years.
Great. So just moving on, maybe let's talk about the market opportunity. How do you quantify or think about the addressable market over time, and also what can that imply for the growth of your book?
Yes. And so let's start big picture for the cannabis industry. Most estimates size the cannabis industry, both the legal market and the illicit market, at over $100 billion. Today, the state legal market is approaching $30 billion. And so if you think about that, there is a $70 billion illicit market to be converted from the illicit channel into the legal channel. And that's significant growth opportunity ahead. Also put this in a couple of other contexts. Number one, only 52% of Americans live in a state with adult use cannabis today. And you have roughly, I think it's about 88% of Americans live in a state with medical use. And so you have significant populations that have yet to be able to purchase recreational cannabis. And so as you watch those medical states convert to adult use states, we'll be unlocking growth. And then I think the addressable market even expands from the $100 billion opportunity as you grow the customer base for cannabis. The more we normalize cannabis as a product segment, and the more we see legalization approach and ultimately legalization occur, I think you'll see that the $100 billion TAM continue to grow. So what does that mean for NewLake? Well, that's a significant amount of product that needs to be grown, manufactured, packaged, delivered, and dispensed. And that's all going to need different forms of real estate. And so we'll be there to provide capital to the industry to be able to fuel that growth and fuel that need provide that real estate capital for that need to expand their footprint to deliver into that significant market growth that we see happening over the next 5 to 15 years.
And on that point, when you think of the regulatory environment and potential changes at the federal level or state level, how do you expect those changes to play out, and what impact would they have specifically on your business?
Yes, and so the federal changes, I think, will happen slowly. We're currently, as we sit here today, we're currently waiting for the DEA's comment period to complete. Excuse me, let me get the light going again. We're waiting for the DEA's comment period to be completed. This is the rescheduling of cannabis from Schedule 1 to Schedule 3. That does not legalize cannabis. That just moves it to another schedule. I think we have quite some time to go at the federal level to get cannabis legalized. And that will continue to limit the opportunities for the industry to seek sources of capital for their entire business, but particularly for real estate needs. And so we see continued demand, not just for real estate, but continued demand for NewLake's capital in that ecosystem. And that'll happen over time. It's not going to be, in my opinion, a flip the switch. I think we'll continue to see states adopt adult use programs. And while the first rolling of states that legalized and adopted adult use were typically blue states, we have seen some of the red states start to flip into an adult use market. As an example, Missouri flipped to an adult use market a couple of years ago. That market launched approximately a year ago. It was midterm elections where voters approved it. It was about 56% approval. Last year, we saw Ohio, Pablo, as you know, and you've been doing a lot of work around this. Ohio is getting ready to launch their adult use program, and it was about a 57% approval at the ballot box last November. And we have Florida on the ballot for this coming November. And as of yesterday, I think it was yesterday or the day before, the Secretary of State of South Dakota has approved the initiative to get it on the ballot in South Dakota. So we see significant progress at the state level of advancing cannabis as a product category. And that's just going to continue to bolster the opportunity set for us.
Great. Look, and just looking back over the last year, maybe talk about the performance of your book. Just give some context to your growth during that time.
Yes. So for those not familiar or as familiar with the cannabis industry, it goes through cycles like any other industry that's out there. And during early 2021, there was significant capital raise, significant debt put on the industry to enter into a rapid period of growth with the expectation, falsely I might add, but the industry falsely expected that President Biden would use his executive powers to legalize cannabis. We were always fairly negative on that as a likelihood. But nonetheless, there was significant capital raised, significant expansion occurred during late 21 into 2022. And you ended up seeing an industry that was oversupplied in many markets. And so late 22 into 2023 witnessed a severe contraction in the industry. Capital dried up, margins decreased, volumes decreased, top line revenue growth really hit stall speed. So some called 2023 the nuclear winter for the cannabis industry. NewLake wasn't without issue. We had one issue in the portfolio. We were able to resolve that issue in the portfolio, and we announced that in late third quarter, early fourth quarter. And so our fourth quarter performance, first quarter performance, as announced, 100% of our properties have been rented, 100% of our rent has been collected. And arguably, I think that's probably putting us up there at the best performance in the industry, both public and private companies. And so we're proud to have come through 2023 feeling relatively healthy. We recently closed a new transaction, so we're back to deploying capital. And I'd also note that we resumed the increase in our dividend. Our dividend has now increased over 70% since our IPO in 2021. So back on track and feeling good about where we sit here today.
Right. So maybe just to, before we jump into Q&A, let's talk about the valuation of the stock. How do you think about, discount to NAV right now, your dividend yield versus also AFO paid, and your debt leverage, and put all that together in the context of peers in terms of how that makes the valuation of the stock attractive right now?
Sure. So feeling better about it today than we were last summer. Valuation last summer was very challenged because we were in the middle of that nuclear winter for the cannabis industry. There were many, many defaults, both public and private, around the real estate sector. And so a lot of people looked at us and said there must be a lot more lurking beneath the surface, but in addition to this one that you have going. And so that severely impacted us. And what I think anybody that goes back and looks at what we did last year in terms of enhancing shareholder value through that period, we initiated a share buyback. We purchased over 900,000 shares at an average price of around $13 a share. So we think that was nicely accretive and a way to build shareholder value and take advantage of what we saw as an extremely undervalued stock price. Where we stand today is closer to our book value or our NAV. Are we happy with where we are? No. We think that we continue to be undervalued relative to the quality of the portfolio. And let me say it this way. When we meet with investors, they will look at our dividend yield and they'll say, Anthony, you're paying out a 9 to 10% dividend yield. And that usually means one of two things. It either means you have a leverage issue or you have a portfolio issue. And then we walk them through these two factors. And we just talked about the portfolio, and 100% of our properties are rented. So 100% of our capital is deployed. And we have 100% of our rent collected. And so it's clearly not a portfolio issue. So then it must be a leverage issue, Anthony. You've over-levered. Well, no, not the case. We are almost nearly unlevered. We have over $430 million of assets, and we have only $4 million of debt on our balance sheet. We have a $90 million credit facility with $86 million available to us for continued growth in our portfolio to execute new transactions as well as to fund existing commitments. And so investors then realize that there's a real opportunity. And again, here's where we think the opportunity is. There's a real opportunity to receive a nice, healthy dividend yield while we're waiting for catalysts to bring institutional investors into our stock that will unlock some of that additional value. If you look at where we are relative to a trading on a cap rate basis, we're trading in the low double digits, call it 11 to 11.5% cap rate. You look at some of our public peers that are also net lease REITs, they're trading at more of a 9% cap rate. I'd argue that even though maybe there's a size advantage on the one hand, I'd say there's a quality advantage for NewLake on the other hand. We run our business to qualify for all listing requirements for New York or NASDAQ, but we're listed on the OTC. We love the OTC, nothing against the OTC, but certainly it's a deeper pool of liquidity for New York and NASDAQ. Again, we run our business to comply with all those listing requirements, other than the fact that we focus on the cannabis industry. And so therefore that limits the institutional participation, limits custody for our stock. So we know that's a real issue and we're working at that to resolve it. But once the institutions can move in, I'd say that's when the real value appreciation occurs. And so going from an 11.5 cap to even where our peer is trading at a 9 cap is a significant appreciation in the stock price itself. So we think it's an attractive yield to get paid while you're waiting for us to get to that appreciation just to our peer. But I would add that publicly traded net lease REITs are trading around a 6% average cap rate. So that's just further upside on the stock price. And so we won't be happy until we think institutional investors can play in our stock and that they reasonably value the quality, long duration cash flows that we've developed.
Thank you, Anthony. So look, just jump into Q&A. Two-part question. What is your outlook for interest rates, and how do interest rate fluctuations affect your business?
Yeah, less sensitive to interest rate fluctuations for our business because we don't have any floating rate debt. Our debt is fixed rate for the next year, and it does then float to prime +1. This is publicly available information, but in the interim, we're enjoying a 5.65% fixed rate on the debt that we do have. How our view on rates is higher for longer. I don't think we're in a minority in believing that. We've been saying that for quite some time. And it's been part of the dialogue with the industry, where the industry does always believe that their cost of capital will come down appreciably. And I just don't see that happening, whether it be for debt or for cap rates. We do think we're going to be higher for longer. And quite frankly, I think that does play to the opportunity for sale leaseback transactions with the operators.
That's good. And in terms of how will your business be impacted if cannabis is rescheduled from 1 to 3?
Yeah. Oh, thank you for that question, because very positively, if you think about it this way, schedule, as you know, but some may not, the difference between Schedule 1 and Schedule 3 for the cannabis industry, the primary benefit is the elimination of the onerous 280E taxation regime. This is a limitation on deductions for anybody that sells products on either Schedule 1 or Schedule 2. We estimate with the elimination of 280E's applicability to our tenant base, that across our tenant base, all of our tenants will see approximately $500 million across the tenant base in improved free cash flow by not having to pay those onerous additional taxes. That is a significant credit improvement. And we've yet to identify any REIT over the last few decades that has benefited, that has had a positive impact across every tenant in its portfolio from one regulatory shift or one sort of tax benefit to the extent that we're having in our portfolio. So it immediately improves the credit quality of all of our tenants, number one. Number two, we also think it has the opportunity to usher in a re-rating of equities in the sector, because they'll all be better quality companies from a cash flow perspective. That re-rating will bring in incremental institutional investors for the cannabis industry. It'll allow a number of companies in the industry to issue equity to recapitalize balance sheets, lowering debt levels, which only serves to improve cash flow by reducing interest expense. a better balance sheet and a better P&L means better credit quality for us. That's yet another benefit, a second derivation benefit of rescheduling for us in our portfolio that we think would unfold over the ensuing 12 to 18 months. So we view the move from Schedule 1 to Schedule 3 as terrific. We don't actually see it creating any additional competition. You heard me say earlier, very few companies have less competition than when they started the previous 5 years. We've seen a number of folks that were in business in 2019 that are not in business anymore and don't have access to capital to be able to continue to grow their business. And so we feel really good about having capital available, having a proven model that has been differentiated in terms of delivering quality for shareholders.
Another question, similar type of question, in terms of safer banking, do you believe that will go through? They are talking about a lighter version right now that's in an appropriations bill. And how would that impact your business?
Yeah. First, I'd say we're very excited to see that appropriations language yesterday come out of committee, and we hope it sticks to the end. We root for safe banking. For anybody that is on Twitter, at Anthony Caniglio, the O is actually a 0. But I was tweeting, I was in Washington recently advocating for safer banking and lobbying for the bill. So we're a big supporter of safer banking. We think it's good for the industry. We think it's good to bring in incremental capital to the industry, but we do not see it as creating competitive dynamics for NewLake. Again, banks will tend to take haircuts based on non-cannabis value. So when we talk to a cannabis company about a property they have $20 million invested in, they're likely to get maybe $10 million. Actually, not even. They're likely to get less than $10 million from a bank. We would provide typically for capital invested in that building. And so they're not likely to be able to compete with us on advance. In fact, what we think is that we're going to benefit more than the cannabis operators in the first couple of years, because we think banks will want to provide capital to a diversified portfolio of commercial real estate that's professionally managed by a public company like NewLake. And in fact, I'll just point to our $90 million credit facility with 3 banks. We were able to put that in place 2 years ago, before banks really were turning to directly lending to some of the top organizations in the industry. So we see it as benefiting us. But the last point I'd make here is one of the changes that has happened in the safe banking bill over the last year is an extension on the time that regulators have to write the rules. This is a very complex rule writing process for federal banking regulators. Think of another industry that's federally illegal in some states and legal maybe in some other states where a bank may operate. So we think it takes them longer than a year to do the work that's necessary to write the rules. And we think that'll limit banks moving in. Banks like to see the rules set before they start providing services and products.
Let me squeeze in a couple of more questions. I think we have 2 or 3 minutes left, but is there a risk of inaction, with some potential borrowers waiting out, safer banking or waiting out rescheduling, and that, it's more difficult for you to do business or new business in the interim?
So we recently closed on a $16 million transaction with one of the leading private companies in the industry, C3. It's a property in Connecticut, a limited license state, really attractive dynamics. And we think that's an example of where organizations see sale-leaseback as a strong tool to be in their cap stack as they seek to grow and expand. But absolutely, there are some companies that will hold out. We don't actually look at those as losses. We look at those as future deals, because I think most operators in the sector understand the concept that they don't want to use their equity capital to hold on to a hard asset like commercial real estate. I think most C-suites believe that their investors invested money with them to provide return and to grow EBITDA and to grow value in the portfolio through the underlying cannabis business, not to sit on a bunch of real estate. And so it's just a matter of time until those transactions come into our portfolio. And it's really about when do we intersect in terms of the cost of capital that they're looking for versus the cost of the sale leaseback and the cost of our capital. So it'll just take time, but we see those as future opportunities.
The very last question. If you cannot list in the NASDAQ in the interim or NYSE, is the TSX an option? Just a quick answer.
We've announced on our calls that certainly we're looking at what TerraSend and Cureleaf have accomplished, not to mention what Sundial and Scott's Miracle Grow are potentially looking to do. So we are looking at TSX and trying to think through how we can qualify to get listed on TSX. And we admire that both of those companies were able to do the work and open up custody. We think they've shown that you could open up custody.
Thank you, Anthony. Thank you, KCSA and Phil Carlson for inviting us. And any closing remarks, Anthony? And thank you again.
Thank you, Pablo. Always enjoy talking with you. Thank you to KCSA and OTC for hosting us. If anybody wants more information on NewLake, you can find us at newlake.com.